We just looked at a client's books, and even though they made a few $100,000 in profit last quarter, they still bounced a payroll check. If that sounds insane, it happens way more often than you think. According to the Fed Small Business Report, over half of businesses cite uneven cash flow as a major challenge. Research shows 82% of business failures are tied directly to cash flow problems, not lack of profitability. So as you're planning for 2026, you need to understand this. Your P&L might say you're winning, but if you can't make payroll, pay your tax bill, or invest in growth when you need to, you might be one bad month away from a crisis. By the end of this video, you're going to understand exactly why this happens, the 3 timing gaps that kill even profitable businesses, and the forecasting strategy that CFOs use to make sure that cash is always there when you need it. If you want one strategy like this that takes 10 minutes to learn but saves you thousands, hit subscribe. Every week, we're covering topics that every business owner needs to know and things that they think they know but are often missing. But first, you need to understand why your accountant can tell you you're profitable and your bank account can still be empty. Look, profit and cash flow are not the same thing. Most owners don't realize this until they're in trouble. If you're running accrual financials, your P&L records revenue when you earn it, not when you collect it, and it records expenses when you incur them, not when you pay them. So on paper, you closed a $200,000 deal in October and your P&L says you made money. But the client has net 60 payment terms, so you won't actually see the cash until December. Meanwhile, payroll hits every 2 weeks, rent is due on the 1st, and your quarterly tax estimate, that's due in September, January, April, and June, regardless of whether your clients have paid you. This is the timing trap. And if you're running a business between $5 and $20 million in revenue, this problem doesn't get any easier, it gets exponentially harder. Because now you've got bigger contracts with longer payment terms, more overhead that's fixed and non-negotiable, larger tax bills that come in waves, or debt payments if you borrowed to grow. And this is what nobody tells you. Your bookkeeper is doing their job, your CPA is doing their job, but nobody's responsible for managing cash other than you. That's the part that falls through the cracks. And that's what we need to fix as we head into 2026. Let me show you how bad this can get. We saw a business with $12 million in revenue and 22% net margin. On paper, they were crushing it, but they couldn't cover a $90,000 tax payment because their cash was all tied up. So looking deeper into their numbers, they had $2.1 million in AR, money owed to them, but still sitting unpaid. And the average time to collect their AR is 67 days, where the industry benchmark was around 38. Meanwhile, they've been aggressive about paying their vendors early to get discounts. Sounds smart, right? Except they paid out cash they didn't have yet to save 2%. And then they had no cash when the IRS came knocking. Their profit on the P&L? Beautiful. Cash in the bank? Gone. If you want to avoid this, especially heading into the new year, you need to stop treating your P&L like a scoreboard and start forecasting cash like a CFO. And I'll show you how to do this in the rest of the video. Okay, so let's break down the 3 timing traps that kill cash flow, even when you're profitable, and what to do about each one. Number 1, the AR black hole. This is a big one. You close a deal, you record revenue, you feel great, your P&L looks great, but the cash, it's sitting in accounts receivable, which is just a fancy way of saying people owe you money that you don't have. And this problem can get worse as you grow. The bigger your business gets, the longer some of your customers may take to pay. A recent survey found that 39% of businesses have less than 1 month of cash reserves. If your customers are paying you in 60, 75, or 90 days, that's trouble. Let me give you another example. Let's say you run a $10 million business and you grow 20% next year. That's $2 million in revenue. Amazing, right? But if your customers pay you in 60 days, you just locked up an extra $333,000 in receivables that you can't spend. You still have to pay your team, you still have to pay rent, and your software, and all your materials, all before your customers pay you. This is what we call growing broke. Your P&L says you're winning, your bank account says you're dying. Here's what CFOs do differently. They track days sales outstanding. That's how long it takes on average to collect payments. And best-in-class companies keep this within 45 days or lower. And in a minute, I'm going to show you the one forecasting tool that makes this automatic. But first, you need to understand the timing trap number 2, because this one sneaks up on many people. Number 2 is a tax torpedo. Quick question. When do you pay taxes? Most owners say April 15th, and unfortunately, they're wrong. If you're profitable, you're supposed to make quarterly estimated payments: April, June, September, and January. And the brutal part is those estimates are based on either last year's profit or this year's projection, which means if you have a great Q1 and you think that trend is going to continue, then you're gonna have a big tax bill in April when you're probably trying to pay the balance of last year's taxes too. We've seen $10 million companies getting hit with $150,000 of combined tax in April, and they have to figure out where that cash is coming from. Meanwhile, their profit and loss statement from Q1 says they made $200,000. So they're thinking, well, we're fine. But they already spent that profit on inventory and payroll and growth, and cash is gone. So what do? You make sure that you're reserving enough to pay taxes at all times. Whether this is a separate bank account or you're looking at your cash balance and subtract in your mind that 25 to 30% of that balance is gonna go to taxes in the future. That way, when your Q1 estimated payment is due, the cash is sitting there waiting. This is the one thing that our successful clients do that many struggling businesses just don't. It's not sexy, it's not strategy, it's a system. And if you wanna know exactly how much to set aside based on your entity structure and state, drop a comment. We'll reach out and see if we can help you. All right, timing trap number 3, the debt service blind spot. Let's say you took out a loan or a line of credit to grow. Smart move if you can service it. But most owners forget this. Debt payments don't show up on your P&L as an expense. Let me say that again. Your monthly loan payment, well, all of that is not an expense on your P&L. It's split between interest, which is an expense, and principal, which reduces the balance on your balance sheet. So your P&L says you made $60,000 this month, but you have a $15,000 loan payment due. And you look at your profit and loss and think, I've got plenty of room. But that $15,000 has to come out of cash. And if you didn't plan accordingly, you're scrambling. This is why we see so many businesses that are profitable on paper, but feel broke every single month. All right, so how do you actually fix this in 2026? The answer isn't so hard. You need a cash flow forecast. This is a tool that every CFO uses and almost no owners below $20 million are comfortable with. So let me walk you through it. Open a spreadsheet or grab a piece of paper. The first column is the date. Every week or month for the next 13 weeks or 6 months. You're gonna start in the first row with your starting cash balance. What's in the account today? Add rows for every type of cash coming in. Customer payments based on when you'll actually get paid, not when you invoiced, and other income. And then add rows for every type of cash going out. And make sure you put the balance in the right week or the right month, so that way you can project the difference as your cash flow. Some examples of cash going out that are common for every businesses are payroll, rent, loan payments, tax payments, vendor payments. And then you add up the cash that's coming in and you subtract the cash that's going out. And this is your net cash flow. Finally, you're gonna take the beginning balance plus or minus the change in your cash flow to get the ending balance. This ending cash balance is what you're gonna have at the end of the week or the end of the month, depending on your cash flow forecast. Now here's where the magic happens. If week 7 shows you're gonna drop below $50,000 in cash or whatever your marker is, you know that today, which means you can fix it before it becomes a crisis. We work with a client to implement this in January, and by March, they spotted a coming cash gap 3 months in the future. By having this forecast, they had enough time to build a plan to collect faster from their customers, delay non-urgent vendor payments by a few weeks, and adjust the draws that they were taking out of the business. And over time, by doing this, the gap disappeared. They didn't bounce a check, they didn't panic, they managed it. And that's the difference between running your business by looking in the rearview mirror and actually driving it. And that's when you know you've outgrown your basic accounting and finance team and need CFO level support. And depending on whether or not your current team can help you with this, will tell you if you've outgrown your bookkeeper and if you need CFO level support. So your first step for 2026 is build that forecast this week. Now, we have a free template that I'm happy to share, so just drop a comment down below and I'll be happy to send it. And if this video just saved you from a cash crunch, hit subscribe. It tells YouTube to show this to more business owners like you who need it. And we drop a strategy like this every single week. See you in the next one.